Welcome to Catalyst. I'm Brad Smith. We are 30 minutes into the U.S. trading day. Let's get to the three catalysts that we're watching this hour. First up, geopolitical risks rattling financial markets this morning. We'll have full coverage ahead. Plus, President Trump calling for Iran to make a deal. We discuss with Ambassador Marc Ginsberg. And energy in focus as oil spikes by the most in 3 years. We'll discuss how this plays into the president's energy ambitions. All that and more coming up on Catalyst. 30 minutes into the start of U.S. trading, let's get a check of the markets here as we're taking a look at major averages on your screen. You've got a look at the Dow, the S&P 500, and the NASDAQ all in negative territory right now. The Dow lower by about 1.4%. The S&P 500 lower by just about 0.9% right now, and then additionally 0.9% in declines for the NASDAQ composite. The bond market, let's flip on over to that as we're taking a look at the 5, the 10, and the 30-year. They all saw some pretty good auctions over the course of this week, and they are all moving higher right now. 0.9% in gains for the 5-year, and then additionally, you're seeing some fractional gains and moves higher for the 10-year and 30-year as well. We also have breaking consumer sentiment data crossing the wire this morning. The University of Michigan preliminary June consumer sentiment rising to 60.5. The estimate was for 53.6. We're also taking a look here at some of the Michigan year-ahead inflation expectations falling to 5.1% versus 6.6% here. This is a major reading in terms of what we've been able to see over the course of this week. With regard to the inflationary picture here, you had CPI and then additionally producer price index that we've also been monitoring here. And this all setting up for next week as we get into the June FOMC meeting here, where we're going to be watching for how the Fed is looking through some of these inflation prints and really monitoring up against what they've set forth as their benchmark and whether or not it actually brings forward the case for what the markets are anticipating in 50 basis points of cuts through the end of this year. We're going to be watching closely for that. You're taking a look at markets here. As of right now, kind of in the same area that we had seen 30 minutes into the start of trade, but still declines even with some of this most recent data baked in right now. U.S. stocks saw their biggest weekly outflows in almost 3 months, with $9.8 billion pouring out of equities in the week ending June 11th, according to Bank of America data. Given this recent sentiment, we want to know how traders are positioning amid the volatility that we're seeing heading into the weekend. For that, I want to bring in my guest contributor for the hour, Todd Rosenbluth, who is the TMX VettaFi Head of Research. Todd, good to have you here with us today.
Great to be with you.
Let's dive into this. Just talk about some of the flows data that you're seeing right now and what that spells out about the mindset of investors, even as we had seen the S&P 500 get to its highest closing level since February, just yesterday.
Right. So the most recent flows data that we've seen has been a pickup in demand for fixed income ETFs. So core bond ETFs like BND or AGG, those are a couple of those widely held products. We've seen short-term government bond products gain traction. Even gold saw some recent inflows with GLD. But I would note, we are on pace to have $1 trillion of net inflows into ETFs again. We're closing in on 500 mark, which is tremendous at the halfway mark. Unlike last year where we crossed $1 trillion, this has been a much more volatile time period for the equity market and the fixed income market, so it's great to see investors, even though they pulled back a bit in terms of the equity flows that you noted earlier, there's still overall demand for ETFs. It's more of a rotation than a moving money to the sidelines.
On the whole, what is the typical flows activity that we tend to see, especially when there is overnight development and conflict in the Middle East, the most recent consideration that investors also have to look across their portfolio, look across their watch list, and really assess where they might need to rotate, at least in the interim period of time?
So given the strong rally that we saw and then the news that came out about what's going on in Israel and the Middle East, it's more likely that we're going to see a rotation today and perhaps into early next week into the more defensive ways of investing. That's fixed income, short-term fixed income, gold, and even the more defensive equity investment styles, the higher quality, the more stable free cash flow, and we're likely to see energy products gain demand. AMLP is one of those more defensive energy products, it's Yahoo MLP ETF. We're likely to see, as investors are rediscovering energy given the rally and its defensive characteristics, that's an ETF we have our eye on.
Todd, stick with us. We got a lot to discuss throughout the hour here. I want to switch gears here, and it is something that we've been tracking throughout the morning. Global markets shaken by the conflict between Israel and Iran. Iran reportedly describing Israel's strike as a declaration of war. Israeli Prime Minister Benjamin Netanyahu says the fighting will last, quote, as many days as it takes, end quote. And President Donald Trump is urging Iran to reach a nuclear deal in the wake of these attacks. Joining us now with his insight on the matter, we've got Marc Ginsberg. He is currently the president of the Coalition for Safer Web, as well as the former ambassador to Morocco and former White House Middle East advisor here. Good to have you here. Thank you for taking the time. So first and foremost, just take us into what your immediate thought process would be after hearing the commentary from the Israeli Prime Minister Benjamin Netanyahu and also seeing what played out overnight.
The Israelis have essentially done three things here in their initial attack. One, they did an incredible job decapitating the military leadership of Iran. Number two, they did some damage to one of the major nuclear sites in Natanz, but they haven't touched other nuclear sites in a degree that they would consider to be satisfactorily hit. And number three, they essentially did a Ukrainian gambit. The Mossad was able to infiltrate into Iran some facility that was able to permit them to launch drones inside Iran against these installations and Iran's defenses.
We do know that there are voices internationally sounding off on this right now. You've got India's Prime Minister Narendra Modi saying that they spoke with Netanyahu, urged peace in a post on X as well. We also have the Japan trade chief speaking to reporters as well right now in D.C. and many of them acknowledging this. And then, you've got the Prime Minister in the UK, Keir Starmer, saying that the UK has grave concerns about the Iran nuclear program here. Just synthesize some of the international reaction from the conversations that you imagine U.S. officials are having at the same time that, they were set to do a different type of conversation with regard to some of the tariff policy, and now it's this instead.
Look, Israel has been increasingly isolated from its allies over its war in Gaza, and Netanyahu essentially changed the equation by launching this preemptive attack. Israel would have continued to be isolated, but I suspect that most of the Israeli allies, including the United States, are privately commending what essentially Israel has done, because Israel has proven before that it is not willing to wait to let either Syria or Saddam Hussein be able to nuclearize uranium into a weapon. Now, what does that translate into? I think the only card that Iran has right now in terms of getting greater international support is to interrupt oil shipments out of the Straits of Hormuz. The other thing it's going to probably having to calculate is, does it somehow crawl back into a negotiation with the United States and resume a nuclear agreement negotiation this weekend? I find that highly unlikely, because it collapsed because the Iranians refused to cross the red line that the United States imposed on it, i.e., it had to export its uranium enrichment program out of Iran, and the supreme leader rejected that, and that's why, in effect, you see these attacks today.
I don't want to make you have to kind of read the minds of investors and of some of the strategists on Wall Street that have warned about black swan events or exogenous threats that could tank this market, but is this the potential match to that type, or the spark to that type of exogenous threats that the markets are very much concerned about, despite the rally back from the depths of the tariff policy turmoil that we had seen?
You've got an excellent point that you just made, because Israel has essentially stated that these are going to be rolling attacks over several days. If the regime considers that these attacks are targeting civil leaders, including the supreme leader, if they believe that the regime is now itself under threat, there's no question in my mind that Iran will try to, in effect, interrupt oil shipments in the Straits of Hormuz in order to gain more pressure on Israel. And you can be certain that that is the black swan event that I'm concerned about.
With this in mind, you also have President Trump, who has been taking to Truth Social throughout the night and this morning, evergreen, but at the same time talking about what Iran should be doing and pushing them to make a deal. Is there the likelihood that we see Iran make a deal, especially knowing what the president had been calling for what he says 60 days now?
It's hard to calculate why would the regime resume negotiations with the United States when it already rejected the terms that would permit, what in effect would have required Iran to agree to join a consortium of the United States and other Arab states in which uranium would be enriched under their supervision outside of Iran. That would be seen as a complete capitulation from the position that the supreme leader has taken. Will Israeli military pressure force the Iranians to try to save face with that and give Trump an opportunity to try to get these negotiations back on track? Look, I think the next 48 hours will tell.
You know, you mentioned something really key, former ambassador, about the Strait of Hormuz, a disruption in the Strait of Hormuz. How long would that take to unwind if we did see that disrupt oil shipping routes, global energy supply and prices?
Look, all it takes is blowing up a tanker in the middle of the Straits to send the shockwaves around the world. Iran has more than enough naval capacity out of its major ports along the Gulf to be able to attack any shipments that are continuing, as well as to threaten to attack shipments, which would cause a huge escalation in maritime prices.
And so all of this considered, what would be your checklist for watching either a diffusion of this matter or keeping tabs on what could potentially come next in escalations?
Whether or not the Israelis are able to declare that they did substantial damage to the key nuclear sites that it is targeting, and that remains to be seen. And so these rolling attacks are key. So that's point one. Point two, what is the Iranian response? They sent drones in to attack Israel. Almost all, I believe, were intercepted. Will they launch ballistic missiles against Israel's civilian centers and possibly target American forces? Those are the things that I'm looking at.
Former Ambassador Marc Ginsberg, thank you so much for joining Yahoo Finance this morning. We appreciate it.
My pleasure.
Just before we go to break, I do want to get the reaction from my guest contributor this morning. Just what you heard from Marc Ginsberg there, especially as we're watching closely for some of those items that were on his checklist and the potential for these exogenous threats to really rise in the face of investors right now.
Yeah, so I mean, investors should have a long time horizon, and many ETF-oriented investors have a long time horizon, but people tend to sell first, certainly heading into the weekend, and might be more inclined to do so. So rotating into something more defensive, less volatile, into short-term fixed income could be more prudent if you're nervous about what a former ambassador said of the next 48 hours.
We've got a little bit more to discuss and break down here over the course of this hour. Thank you, Todd. Stick around. We've got all your markets action straight ahead. Stay tuned. You're watching Catalyst.
Every market has a hidden calendar, and small cap stocks have a rhythm all of their own. But how much does the presidential cycle actually matter? And is 2025 already breaking all of the rules? Today, we revisit seasonality. I'm Jared Blickery, host of Stocks in Translation. And first, the definition. Seasonality is the predictable and recurring changes in data that tend to happen at the same time every year. And we've talked about this. Well, I've talked about this at the beginning of the year. But guess what? Seasonality did not predict anything in regards to the tariff tantrum that we saw, and that kind of bucks seasonality in a big way, but it seems to be back. So let's take a look at this chart. The Russell 2000 started in the late 70s, so this goes all the way back to 1979. Every month, these green bars are the median returns, not the average, because that can skew things to the upside or the downside too much, but we take the median returns. And then in white, I also have the percent positive. And I like to see something above 70% to get me really bullish, because that is a historical average or median for any given day in most stock indices. So we're going to notice here, June is kind of ho-hum. That's about 1.3%. And what you might notice is that May is a lot better. And in fact, we were just coming off the best May since last November. And guess what here? November is the best month of the year, historically speaking, with a positive rate of about 70%. And December is right there with it. 74% of the time, it is up over 2%. So you put it all together, we are still in the midst of a nice little seasonality, perhaps backed run in the Russell 2000 with small caps, and we did see them lead this week in particular. Now let's take a little different look here, and you can slice seasonality in a lot of different ways, but one of the ways is to match the presidential cycle. So since 1979, we've had 11 or so first-year presidential terms, all the way from Ronald Reagan, he had 2, and then you had H.W. Bush, and then you had 2 of Clinton, all the way through Biden. And so that's what we're looking at here. And with only 11 sample sizes here, we're seeing a lot more volatility. So the green bars are going to vary a bit more. But what you might notice is the standout month is May. And again, we just had the best May since last November. And historically, with this presidential cycle, we've seen returns of about 4%, 91% of the time, 3% plus. Also, June, again, ho-hum. It's a little bit less than 1% there, but it does have a percent positive of about 73%. And then July looks a little bit better. What you might notice here is that August and September are really not the greatest months in this cycle. So that's something to look out for potentially, especially August, which has a median negative return and also only a 45% positive rate, which is pretty low here. And I'm going to show a final chart. Hopefully I'm not going to confuse things anymore, but I did want to show you what has happened this year, and that is in blue here. So this is a 2025 chart. Here we have, I'm going to trace out what the Russell 2000 has done this year, and there's that big plunge into the early April that we saw. And then I have 2 maps, the white and the green lines. Now the white line is going to closely match what has happened, that first bar chart that I showed you, since 1979 every year in those median returns. And you can see it's pretty much from the lower left to the upper right here. We do kind of flatten out in the fall a little bit, but then there's a rise into year end. But what I'm really interested in is that green line. And this is a special way I've been conducting these seasonality studies. For everything that's included in here, you have to have the exact same day of the week as it appears in this particular month. So for instance, this month started on June 2nd, and that was a Monday, and we're only going to include those years back to 1979, where June 2nd was a Monday, and that happens to be 1980, 1986, 1997, 2003, 2008, which was the global financial crisis, and also 2014. And what we see here is a bit of negative seasonality into early April, and that kind of matches, not to the extreme that we saw, but it matches what we saw this year. And so what I'm interested in particular is what's happening in June. We do see a nice upslope here, and when we get to October, November, December, that's when we reach the rocky period. So the bottom line, if you put all of this together and you put some stock in seasonality, we probably have some smooth sailing perhaps until August, September, October, November, and then with the resumption of the uptrend maybe in November and December, and that's if everything goes according to plan. And with all the geopolitics, who knows, we could get another bump up in volatility. But all considered, we do have a map for the year. So tune into Stocks in Translation for more jargon-busting deep dives, new episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Jared, thanks so much. It's now time for some of today's trending tickers. We are watching Citizens Financial, Merck, and Occidental Petroleum. First up, let's check in on Citizens Financial, increasing its share buyback authorization to $1.5 billion. That's an increase of $1.2 billion above the $300 million currently remaining under the prior June 2024 authorization here. You're taking a look at shares. They are slumping with the broader markets right now, down by about 1.3%. But this is a considerable move, especially just what we're seeing within banks more broadly here and some of the appetite for the financial sector right now. What are you seeing in some of those plays as a thematic approach from investors?
Yeah, so banks have actually underperformed much of the year. We've seen outflows. KBE is one of those large diversified bank ETFs that Citizen Financial is part of, and it's down. So it's nice to see the company buying back stock. I think we're going to see more uses of buyback stock. We're looking at companies that have strong free cash flow that have the ability to do that. And for folks that are looking for an ETF real quick, VFLO, Victory Shares Free Cash Flow ETF, companies that have that strong capability to buy back stock.
Great context there. Also, we're tracking this name on the day. Merck getting FDA approval for the use of Keytruda to treat head and neck cancer. The drug had already been approved to treat various other cancers. There you're taking a look at Merck shares rising right now by about 0.3%. And what's noteworthy for a lot of the biopharmaceutical companies and biotechnology companies is many of them trying to figure out what is the next major element of their R&D pipeline that could add to its ability to deliver some of both the margins for investors that have been looking for even more shareholder value, but also just looking for that next big breakthrough. But Keytruda has largely been that for Merck, and that's why they're looking for other sources while also leaning into the ability to prop up, especially through the approvals process, some of the efficacious measures that they've seen so far right now.
Yeah, and it's great to be able to see, healthcare tends to be one of those historically defensive sectors. It also has underperformed for much of the year, so it's great to see a growth driver for one of those large cap companies that you'd find within XLV. I'm going to keep throwing out ETF tickers. I'm an ETF guy.
Look, that's your jam right now. What is the ETF play within healthcare that is seemingly more resilient at this juncture?
Yeah, so XLV is the healthcare sector of the S&P 500, so you're going to get those large cap companies. Biotechnology is a more growth oriented side of it, so IBB would, if you wanted to play that drug pipeline for individual biotechnology companies.
Finally here, let's talk Occidental Petroleum. Occidental Petroleum getting a boost from surging oil prices. The Warren Buffett-backed oil and gas company is one of several energy names climbing today after Israel launched an attack on Iran's nuclear facilities. It earlier today was the top trending ticker on the Yahoo Finance platform. Right now, you're seeing it up at about 3.4%. And this is one of the green areas of the market. We know that this is the typical activity and reaction to when there is conflict that breaks out in one of the most oil and energy and gas rich portions of the world as well.
Right, and so energy is roughly 3% of the S&P 500, so it's a pretty small stake. So when oil prices spike, that's usually a bad thing for the rest of the market. We talked about consumer sentiment earlier,
right,
but
yeah.
Higher oil prices is a negative thing. So folks that want to overweight their exposure to energy, XLE is again that S&P 500 one. I touched on AMLP, which is a more stable MLP-oriented product that's from Malarian. That's a good way of having energy exposure, but not necessarily the same level of volatility.
Yeah, we were talking about, even as you were mentioning, the impacts that consumers typically see when oil prices are lower versus higher. Well, we've had a lower protracted period as well here for a little bit, and that playing into some of what we had seen in the CPI release earlier this week, where we saw the gasoline index fall over the month. The energy index declined by about 1% here. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. We've got all your markets action ahead. Stay tuned. You're watching Catalyst. Oil prices are spiking the most in 3 years following Israel's attack on Iran. Bloomberg Economics projecting that oil prices could reach as high as $130 per barrel. This could further escalation. This escalation, it could risk President Donald Trump's promise to lower energy prices. That's the big question. Joining me now on this, we've got Yahoo Finance Washington correspondent Ben Werschel. Ben, what is the potential risk that it could hit on his promise to lower prices, lower gas that was campaigned upon? And we have seen it play out in some of the inflationary prints, but this a major headwind now.
For sure. Yeah. Good morning, Brad. So this energy has obviously always been a touchy issue for Trump, and we saw evidence of this yesterday, even before these attacks. He was at a White House event and was expressed unhappiness with energy price increases even before last night. He even joked that he was going to call his energy secretary and scream about it. So this is clearly a top of mind issue, and what we saw is the energy prices spike overnight as a result of this. This comes in spite of the fact that these attacks were targeted to nuclear facilities, but it just the fossil fuel side of this is increasingly in concern. And I think part of the reason this has a lot of salience for the White House is this overall inflation question. If oil prices spike, the overall inflation goes up. It is the underpinning of a lot of Trump's economic agenda, the argument for it. Tariffs first and foremost. We had an inflation print earlier this week that was lower, pulled down by the month-over-month decrease in the energy index and a 12% decrease in gasoline over the last year. And that's Trump's case for tariffs, is that tariffs aren't spiking inflation. That's not happening. And so that's why tariffs are great. And this comes right in the middle of his negotiations over what's being called Liberation Day 2.0, where they're going to talk about additional tariffs. It's also an additional complication for Trump and his increasingly combustible relationship with Jerome Powell. He was talking about Powell again yesterday. He called him a numbskull for not lowering rates. And he said Powell should lower rates because inflation's under control. Obviously, if inflation gets less under control, driven by oil changes, it kind of upends his policy on a bunch of different fronts.
All right, Ben, thanks so much for continuing to track this, breaking this down for us. Appreciate it. All your markets action straight ahead. Stay tuned. You're watching Catalyst. The U.S. and China reached a deal this week, a tentative deal on trade, once again opening access to China's much-needed rare earth minerals for American companies. China dominates the global mining and production of crucial materials, which means essentially that the U.S. could once again face a shortage if Beijing cuts off access. Joining me now to dive deeper into this rare mineral supply chain, we've got David Klineski, who is the CEO of Service Solutions, a lithium battery recycling company. Good to have you here with us today. So first, David, just walk us into the significance of China's dominance with rare earths and what a deal with the U.S. would ultimately signal.
Yeah, good morning, Brad. Thanks for having me. It's an interesting opportunity. I think that obviously the U.S. and China have been working on trying to come up with some sort of trade deal. You mentioned, right, over 70% of the rare earth minerals are actually processed and produced in China. Actually, 90% of the rare earths in the world that are used are processed in China, but China has access to a lot of those minerals. So having a deal with China, I think it's a short-term solution. It eases a little bit of the tension there on things where these critical minerals and rare earths are used in just about everything. That's why they're called critical minerals. But longer term, I think the country needs to continue to think about domestic supply chain, domestic manufacturing, and how to reduce our dependence on other countries supplying us with these minerals.
How critical is this portion of the deal to the rest of an agreement between the U.S. and China, knowing where there's so much of the technological purchases, knowing where there are other elements that in a multi-pronged approach, the two largest countries in the world by GDP would also like to have kind of a checklist struck in this broader kind of, whether it be a phase one or a larger phase two of a deal that comes forward?
Yeah, I mean, this is a pretty major accomplishment, I think, for the administration, at least to get some sort of agreement there. If you look at where critical minerals are used, the question is, where aren't they used, right? Everything we touch almost every day has a critical mineral, whether it's something in, again, a vehicle, it could be something in our home, in terms of our kitchen, but also, a lot of our defense systems and defense industry relies on rare earths and critical minerals. So when you think about that at a broader picture, that has a massive impact on the lives of everybody in the United States. And it's something that I think why it's getting a lot of attention is because it is a pretty big deal. And it's something that, we need these critical minerals. We need access to them. There's a lot of them that are in our country today that we obviously can recycle and recover. That's another critical thing, I think, as you think about it. And when I'm talking with the administration, that's something that's kind of, front of mind with them is how do we also make sure that once we have these minerals and rare earths in our country, how do we continue to recycle them and recover them? And that's a huge play right now that our, Service Solutions is working on, and other companies in the United States, to try to domesticate and localize that supply chain for the country.
And so Bloomberg right now reporting that the Trump administration, prioritizing rare earth projects. That is the plan. What is the typical timeline to get these projects up and running?
Yeah, I mean, I think it depends on the scale, obviously. But usually, when you're talking about an operation where you're recycling, recovering, or processing these minerals out of the ground, for example, these these timelines, depending on where you're getting, if you're just recovering and recycling materials, it's a little bit easier because you don't have to get a permit for mining and things like that. You just actually have to build a facility. And typically the build out of those facilities is between 18 months to 2 years. So it does take a little bit of time because you construct a manufacturing plant. If you're talking about mining things, obviously the administration is really focused on streamlining that process of getting mining permits and things like that, which I think will help. But those could take a little bit longer. So, my kind of, my statement in a lot of this is we've got a lot of these minerals on the road right now or in our homes right now. Let's make sure we just recover them now and put these plants in operation to use those critical minerals that are already in use and not in the ground to be recovered.
Where do these minerals typically go into further use, the kind of secondary market, if you will, for them?
Well, the nice thing is about these minerals, once you've recovered and recycled them, they're brand new again, right? So you're recovering them to a quality of like they just basically are start of life again. So, when you think about electric vehicles, for example, you got things like nickel and cobalt, lithium. Once those materials are recovered out of a battery, or it could be a cell phone, a laptop, whatever it might be, those minerals are recovered and basically put back to the original state of their purity, so they can go right back into another battery, another phone, another laptop, whatever it might be. But then there's other applications out there that use these metals for piping and things like that. We got to build a lot of plants, a lot of manufacturing facilities. So you have the opportunity to use those in secondary applications as well.
David, thanks so much for taking the time here with us today.
Thanks, Brad. Appreciate the time. Have a good day.
Certainly. Just want to continue the conversation here on set here because there's also an investor mindset and play around some of these minerals deals. What is the ETF approach that you're seeing kind of transpire?
Yeah, so there's a couple of ETFs that give you exposure to what we were talking about. Sprott has one of them. The ticker, I believe, is SETM, which is a Sprott Critical Minerals ETF, diversified across some of the topics that our prior guest was talking about. VanEck has an ETF, REMX, that has rare earth within the name of it. These are two different thematic-oriented ETFs. We tend to think of thematic ETFs tied to artificial intelligence or cybersecurity, but there are other sectors that you can have a long-term thematic play that's crossing a number of the industries, not just in what you'd find in the traditional diversified materials ETF.
Really interesting. We'll continue to track what some of the flows and what some of the volume looks like into those ETFs, especially with the movements on these deals coming forward here. Appreciate it, Todd.
Thank you.
Coming up, how one FA is advising clients through the market volatility. With a record number of Americans turning 65, more investors than ever are preparing their portfolios for retirement. But with market volatility sending markets swinging so far this year, how can financial advisors guide clients through the volatility? I want to bring in Sarah Mauser, who is the Verdance Capital Advisors Managing Director of Financial Planning, for this week's FA Corner, brought to you by Capital Group. Sarah, good to have you here. What are some of the biggest issues facing your clients right now?
Thank you so much for having me. There is a lot of volatility right now in the markets, and from that comes a lot of planning opportunities to help put clients at ease. So here at Verdance Capital Advisors, we really focus on the planning side of it. And a lot of what clients are coming to us with, the questions they're asking, are coming from what they're hearing in the news. And so a lot of that revolves around potential changes with the proposed tax bill. So a lot of the questions revolve around, especially for our higher net worth clients, how do they most effectively transfer that wealth with where things are today and how they might change? And so a lot of those questions talk about, should I do a Roth conversion? What is a Roth conversion? Should I do it? Should I be transferring money into a trust or gifting money now? And there's a lot of planning that we can do today to lock in knowns before there are some unknowns potentially in the future with what could change.
Are you seeing a push for safe havens amid some of that volatility that some of your clients might be lighting up your own phone about?
For us, we do a really fantastic job of making sure our clients are educated. So on the investment side, we have a tremendous team that makes sure to control the volatility as much as possible within our portfolios. But with the planning that we're doing for clients, that really is putting them at ease from an educational perspective.
So with that in mind, how are you seeing, especially within the silver tsunami, the planning for estates and the estate planning that they're trying to update, set up, and where are they at in those phases kind of on aggregate?
Yeah. So, with clients, it is, can we lock in those knowns now? So if those tax exemptions do sunset, that estate tax exemption is essentially going to be cut in half. And so can you maximize those opportunities now? Can you gift those assets now? There's ways to harvest those opportunities today, and particularly from an estate transfer perspective. Now, if those provisions do get locked in as we look at the bill potentially becoming permanent, there could be additional opportunities as well, but they could also not be there. And so to lock in those opportunities today gives clients a real opportunity to have conversations with their advisors now before potentially those opportunities disappear at the end of this tax year.
And so all this in mind, what are some of the changes that clients and everyone needs to be aware of, especially considering the in-review GOP tax bill right now?
Yeah, it's a very good question. For most taxpayers, there's not going to be dramatic changes. There's going to be increases to some deductions, to how income is taxed. There's talks about how tips and things will be taxed, child tax credit increases, potential deductions for the purchase of a vehicle. Small changes that will impact taxpayers, yes, but not dramatically. The tax changes to tax brackets are set to change slightly, but be relatively stable for most earners. Where the changes are really going to impact are changes to those with a higher net worth and those with a higher income. So as we look at changes potentially to the standard deduction, if that is reduced, are there opportunities to maybe accelerate income in certain ways now in terms of charitable giving, to be able to take that itemized deduction now before that potentially even gets locked in higher. And from an estate perspective is really where we're seeing the biggest impact, as I mentioned earlier, being able to lock in those knowns now. Yes, potentially take advantage of some additional increases in the future that are going to be indexed for inflation. But if those estate tax exemptions do sunset, those high earners and those with a higher net worth could potentially lose out on an ability to significantly transfer wealth in a more efficient way.
How nimble is some of the retirement planning? And I ask that from a perspective of knowing that a lot of the retirement savings practices for those who are closer to retirement tend to be, hey, we've already de-risked to such an extent that we're just trying to make sure that the money continues to grow. We're in less risky parts of the investment spectrum, if you will, while still maintaining a little bit and smaller proportion in our portfolio of risk. But when you have the opportunity and sense that there could be a market rebound like we've seen from the depths in April back to the end of May, early June now, what were they doing within that time period?
That's a good question. Our clients really were not making changes, and we were not recommending drastic changes. Now, we were making nimble tactical changes to the portfolio, but for the most part, our advice was always to stay invested because, as you mentioned, rebounds happen quickly, and taking yourself out of the market, putting money in more conservative investments, and the market timing, when you look at history and the research, it's never in your favor because no one can time the markets. And so our clients were not making changes. But this is where the planning really comes into play, and working with a financial advisor that is focused on financial planning. Because what it really comes down to is it comes down to expenses. At the end of the day, it comes down to expenses. And are you spending in a way that is sustainable for your portfolio? And with some clients, we have the conversation of, when we're sort of in the trenches of volatility, it may need to be a conversation of we're temporarily pulling back and making sure we're planning in a way to be able to do that, to be able to weather that storm.
Yeah. But
when it comes to making changes, it really is, hold on to the side of the kayak. And I know that sounds cliche, but our recommendation has been, allow us to manage the portfolio tactically and hang on because market rebounds happen quickly. And instead, let's focus on the planning side of it and ensure, especially retirees who are looking to retire, are staying within their spending means.
Sarah, thanks so much for taking the time here with us.
Thank you so much for having me. It's been a pleasure.
That was this week's FA Corner, brought to you by Capital Group. Everyone, that does it for this hour. Todd, thanks so much for taking the time here with us in studio. Coming up on the other side of this break, we've got Wealth, dedicated to all of your personal finance needs. Ali Canal has you for the next hour. Stay tuned.